Investing can be a very tricky subject because there are so many different types of investments and terms, and honestly, it can be a little intimidating. If you are a beginner investor or if you want to learn more about investing, today I'm going to talk about the 7 different types of investments that every beginner investor should know. So my name is Sabrina Rainique, and on this channel we live a life that we love while planning for the life that we want, all through personal finance, travel, and lifestyle. So if you like videos like this, please like, comment, and subscribe, and let's get into the video. So the first type of investment that every investor should know is a stock. When you are investing in a stock or buying a stock, you are essentially buying a small piece of a bigger company. So think of the Amazons, Facebooks, Apples of the world. The way you make money when you are investing in a stock is, let's say you buy a stock for $10 and someone is willing to pay $15 for that stock, you're able to profit the $5. So in an ideal situation, you would pay a designated price for the stock and someone would be willing to pay more money for that stock and you profit the difference. So I always hear the stock market being compared to food to kind of help paint the picture of what, the stock market is and how stocks work. Plus, who doesn't like talking about food? So I want you to think of the stock market as a pizza shop. So in this pizza shop, you have all these different types of pizza, and in the stock market, you have all these different types of companies. Now you're walking around the pizza shop, okay? You see a little pepperoni over there, that'll be your Apple. You see a little mushroom over there, that'll be Facebook. You see a little truffle over there, that can be Amazon. And there's just tons of different pizzas all over the pizza shop. Just the way in the stock market, there are tons of different companies. So now after walking around a little bit, you decide that you want the pepperoni. So you decide that you want to invest in Apple. Now you can't buy the whole pizza. You can't buy the entire Apple company. You just want to buy a small fraction of the company. So instead of buying the entire pepperoni pizza, you're just going to buy one slice, and that one slice is going to be equivalent to a stock in Apple. Now let's say you walk outside with your pepperoni pizza, you're so hyped to have this pizza, and then you see 5 people outside and they're like, "Where'd you get that pizza?" So you say, "Yeah, I paid $10 for this slice of pizza," and they're like, "Well, I'm willing to pay you $15. So you give them the slice of pizza for $15 and you profit the $5. So the value of a stock can go up or down just depending on demand. And it's really important when you are investing in a stock that you are aware that the stock price could go up, meaning that you make more money, or the stock price could go down, meaning that you lose money. So even though there is potential for you to make money in the stock market, there's also the potential that you will lose money in the stock market. So the next type of investment that every beginner investor should know is bonds. A bond is a loan that you will make to a company or the government, and they will pay you back with interest. So you lend them money, you lend either a company or a government money, and they'll pay you back and put a little something on top. Overall, bonds are considered less risky than stocks. However, they will most likely offer you lower returns or make you less money. And just like any investment, there's always the risk that you won't get your money back. If the company that you have a bond with collapses, for example, you can pretty much assume you won't get your money back. However, United States government bonds are considered less risky. So the less risky the bond, the less profit or return you can expect back. So now we are getting to the interesting stuff. Next, we have mutual funds. So mutual funds are for the investor who looks at the long list of stocks in the stock market and they just close their laptop because they're like, what am I supposed to do with all of this information? Which stocks am I supposed to choose? There are literally thousands of stocks, so it's really hard to determine which one stock you want to choose to invest in. Some investors know this and they decide to, instead of investing in individual stocks, they prefer to invest in mutual funds. So you can really think of this as a basket of stocks. So instead of getting all Facebook stock or all Apple stock, you get a big basket with small shares of various stocks. So a little Apple over there, little Facebook over there, throw some Walmart in there. Mutual funds are really for the people who don't like the idea of picking and choosing individual stock and bonds because there's just so many to choose from and it can be really intimidating. And this is also great for the investor who is looking for an easy way to diversify their investments and diversifying your investments is so important because if one stock or one company isn't doing well and another one is, at least they will balance each other out. Many mutual funds are actively managed, meaning that there is someone there who is doing the research on these stocks, someone who is buying and selling different stocks and bonds based off of what they perceive is going to make money. So essentially, you're paying someone else to do the research and pick all of your stock and bond investment options, and ultimately get the investor the highest profit possible. Now we are continuing to get into the more interesting stuff. So next we have index funds, and index funds are that girl. Index funds are a type of mutual fund where you have a mix of different type of stocks and bonds. So you still have the benefit of diversifying your investment portfolio. Index funds are a little bit different, however, because they are passively managed to track the performance of an index or a specific group of assets. So two things right there, indexes and passively managed. Indexes typically measure a basket of stocks and bonds and other investments which are intended to replicate a certain area of the market. To give you an example of a popular index, think about the S&P 500. So the S&P 500 is an index that manages the performance of the top 500 companies in the stock market. So in that example, you would be able to invest in an index that is mimicking or replicating the S&P 500. There are so many different types of index funds. There's the S&P 500, there's the total market index fund that replicates the performance of every stock in the stock market. There's one for international markets, there's one for technology companies. So like I said, there are a ton of different index funds that you could choose to invest in, and essentially you'd be investing in a basket of stocks and bonds and other investments that fall within that category. And you do get that automatic diversification, so that's the great benefit of an index fund. Now the second thing to note is the fact that these are passively managed, so you don't have to pay someone to do all that research and really manage the fund. Now it costs you way less money to invest in an index fund versus investing with an actively managed mutual fund. There are so many fees associated with working with an actively managed mutual fund that you don't have with an index fund. And over time, over the years, those fees really do add up, especially the more your money grows in its investment. So I love index funds, and index funds are so powerful. One, because you get immediate diversification, which does make your investments safer. Two, because when you are able to invest in an index like the S&P 500, for example, if you look at historic data, over time the S&P 500 and just the overall market has always grown. So that means that your money is growing too. And then lastly, because there are less fees associated with an index fund versus a mutual fund. So when your money is growing in an investment, you get to keep more of that money instead of having to pay someone else to manage your investments for you. So next we have exchange traded funds, or ETFs. And ETFs are very similar to an index fund in the sense that they track indexes and are not actively managed. So the major difference between an index fund and an ETF is ETFs are bought and sold on the stock market, and their price fluctuates throughout the day just like a regular stock. ETFs are also great because you get that immediate diversification. It's also a basket of different stocks, bonds, and other investments. So you don't have to choose individual stocks with an ETF. These are also passively managed, so you don't have to pay someone else to manage these investments for you. And even when I first started investing, I started investing in ETFs and they were great. So next we have options, and options are a bit more complicated and a bit more tricky, but I know that this is a increasingly popular investment type, so I thought it would be great to talk about it today. So an option is a contract to buy or sell a stock at a specific date and price in the future. Options are able to provide you some sort of flexibility as an investor because you don't have to buy the stock itself. You're not obligated to buy the stock. It gives you the right and the opportunity to buy that stock at a specified date and price in the future. So essentially, when you buy an option, you're not buying the stock stock itself. You're just buying the contract that says, hey, I can buy this stock in the future at a specific date and price. As an investor in options, you can do three things. You can either buy or sell the stock at the agreed upon price and date in the future. You can either let the contract expire, or you can sell the contract to another investor. So basically, as an options investor, you're predicting that a stock is going to be worth way more than what's in the contract that you bought. So let's say you get to that designated date in the future and you see the stock price has skyrocketed, but in your options contract, you have stated that you can buy this stock for a much lower price. In that case, you're able to profit on the price of the stock because it's way more than you're buying it for. So if your prediction is correct, then you make money, but if your prediction is incorrect, then you only lose out on the price of the contract. Lastly, we have certificates of deposit, or CDs. So a CD is when you give the bank a certain amount of money or a loan for a predetermined amount of time, and when that period is over, the bank is going to pay you back and give you interest on top of that. The longer the period of the loan, the higher the interest you'll receive. CDs are FDIC insured up until $250,000, which would cover your money even if the bank did collapse. So those are super low risk. Now, you do need to ensure that you don't need the money that you put into your CD until the designated time, because there are major penalties if you try to withdraw your money beforehand. I hope this was helpful. As a beginner investor myself, I do plan on doing more videos on investing for beginners. If you like this video, please like, comment, and subscribe, and let me know what kind of videos you'd like to see about investing. I will see you all next week. Bye everyone.